Thank you, everyone. I'm Valeria Laszlo from McKinsey. I'm based in Budapest, but I'm leading the global team of banking strategy and innovation, focusing on long-term strategy for banks as well as the fintech space. And I promise Morten to be as fast as possible, given the but the content is not easy, so bear with me, and I will try to walk you through. So I'd like to open the conference with a bit talking about what happened in banking and what is the macro outlook. We have an exciting year behind us. We had a fairly flat decade of not much excitement happening. Obviously, on a day-to-day basis, that's not the case. But compared to how 2022 and the beginning of 2023 turned out, it was definitely a very flat decade. So things that changed, definitely on profitability and revenue growth, slightly above GDP. Then higher risk cost again, with way more divergence than before. We had huge differences in geographic spreads. And one thing I would mention is, out of all the list, is the new social contract, so the change in how we look at ESG versus sustainability in a more broader sense. So a lot of things changed, but there is one thing that haven't changed, despite all this turbulence and volatility. That's actually the valuation and the value creation of banks. So what I'd like to do is a bit walk you through like all the changes of the past 1.5 years, and how it's still not impacted the valuation, and what are the potential ways to turn banking in general to a value-creating industry. So just to summarize, in the past year, what happened is that we had a mix of effects from COVID impacting labor costs, supply chains, and so on. But at the same time, we had the macroeconomic shocks. And all in all, this leads to high inflation and high volatility environment. So this is for banks, I wouldn't say that explicitly bad or good, but definitely a high volatility environment, which wasn't the case for the past decade. This has hit all regions, but obviously not equally. Some regions like Middle East was less hit, and unfortunately Europe is one of the most affected by all these 5 factors that we identified. And then one interesting thing that really changed over the past couple of months is that if we look at the performance of emerging countries and developed countries, in the past there used to be a performance plus for emerging countries. And by now, this is completely diminished. So it's no longer a decisive factor of performance. But what we see is that all these countries, regardless of whether they fall into the developed or the emerging countries, they are quite divergent in terms of performance. So if we look at the developing countries, there is China with the asset bubble burst, which is definitely underperforming, versus we see countries like India on the top end. And if you look at the developed world, similarly, we see a lot of divergence, where Europe, Japan is underperforming, versus US and Canada is doing fairly well. So all in all, this has shifted in the past couple of months, and a bit rearranged how we look at the global banking markets. Moving further, looking at not by geographies, but more like asset classes, one thing that we have seen is, while all the revenues increased to 6.5 trillion, the new shift is that there is a lot of value added from actually the margin impact. So if there was not the margin impact coming from all the effects of inflation and high interest rate, just based on the volume impact, it would have been not an easy year for banks, but the margin impact contributed a lot, which was not the case compared to the past decade. And another interesting thing is, if we are looking at the various asset classes in banking, CIMB is definitely underperforming despite the high hopes in the past. And what brought in the growth is coming mostly from bread and butter of banking. So everyday banking, mortgages, and so on. So this is, again, a bit of shift in how the revenue pools are consisted. There is, though, as I mentioned earlier, already the punchline. One thing that didn't shift is the value creation of banks. We checked the profitability of banks based on whether they are earning below or under the cost of equity. And still, majority of banks are performing below cost of equity. And then even if we are looking at the ones which are performing at this like 1-2% above cost of equity, that's only 35% of the banks. So that's a shocking image about the industry. But it's also, there is an upside, because there is definitely a value creation potential. What we see is that this is also reflected, this performance is already reflected in the valuation of banks. still earning 70% at a 70% discount compared to other industries. And when checking what is the rationale behind this discount, we see that the reduced profitability is just one bit of the puzzle. The other bit is definitely the impaired growth outlook. But there is good news. We see high performers who are managing to fix both the profitability outlook and the growth outlook, and we classify them into the North Star, the top right corner of the matrix. And we examined what are the specifics of these top performers or North Star banks who manage to perform both in terms of profitability and growth. And we identified 4 factors for that. One is geography, where they are located, which I mentioned earlier, it's no longer simply about emerging or developed countries. The second is segmentation, having very specific targeted models to the segments, understanding who are their segments and how to serve them. The third aspect was the business model aspect. Often these players performing on the top right corner are specialist players or have a very specific specialist business model, moving into more an ecosystem direction even. And then the third one was definitely coming from scale. So all in all, I would like to focus today on 2 out of these 4 factors. One is just very briefly on segment, and then I will deep dive a bit into the business model and what we see there, what is the big shift. The interesting thing about segmentation is that it's not clear, the revenues are not clearly tied to the age distribution. And we see a lot of divergence based on which country or region we are talking about. One example is US, where banking revenues are primarily driven by the older age group, and this is coming from wealth accumulation. Whereas if we look at China, it's completely distorted. Banking revenue accumulation is happening more in the young generations, driven by consumer finance and mortgages. And really the one and only message is you need to understand your segments, the customers you are serving, and you need to also understand where the profit pools are coming from, because it's not straightforward and there is not clear one recipe. Okay, moving on to the business model. So one thing that we have seen is, as I mentioned earlier, these are all specialist players or have some specific focus within their business model. And this is something that also capital markets tend to appreciate. We checked, and in many countries, the top performance in valuation have very clear business model directions, more focusing more towards ecosystems or platformization. And the rationale behind it is that we see very strong technology trends as well as customer trends. For those of you who have been in the presentation in February at the Banking Renaissance event, this is not going to be news, but we see 4 technology trends that are being broken down and reshifting. One is access to technology. The second one is computing cost and the decrease in computing cost. The third one is how data is managed. And the fourth one is around IoT and DeFi, so all the network technologies. Compare that with the generic wish of customers to be served conveniently, immediately, according to their values, and all of these trends are leading towards a platformized future. And what does it mean for banking, and what does it mean for universal banks? Well, on one hand, it means that all the traditional barriers of universal banks that kept those banks together are being broken down. So the rationale of having a branch network and doing all kind of sales for all kind of segments from those branches are no longer a valid reason, as their role is diminishing. Then the advantage of having the financial data about your customers, that's no longer a clear privilege, because there are so many other data sources to better understand your customers. Thirdly, legacy tech. It was another reason to keep universal banks together and serve various segments from one entity, one approach. With the emergence of cloud technologies, again, this is something that is challenged. And then finally, the capital, with the emergence of PE and VC capital, this is no longer a privilege of large institutions. So all in all, what we see is that all these factors that kept universal banks together and made it rational to operate from one universal entity and serve all kinds of various client needs is somewhat being, not broken, but definitely challenged. And what does it mean? So on one hand, the model of universal banks is challenged on various factors. On the other hand, we have the customers who are looking for platformized solutions. They are looking for servicing of their needs. They are not looking for a mortgage. They want to live somewhere. They want to own a home. So what we foresee is that probably there is going to be a shift from traditional banking business lines more towards the 5 very distinct customer needs of financial intermediation that are now handled under the universal banks. The 5 needs that we identified is everyday banking, complex financing, investment advisory, mass wholesale intermediation, and below the service, the balance sheet and white label services. If we look further into this, we try to also understand like what are the emerging business models, and within each battlefield, so far we identified 2 emerging business models depending on where we look. I'm not going to go into details because more time will be super unhappy with the time needed, but happy to discuss later on like what are the specifics of these emerging business models and how they are shifting from the traditional business lines. So this is what we expect on the long run in terms of the business model shift, and this is what we expect that top performers will have to adapt to at some point, but the question mark is when, and it's not clear. There are a lot of differences based on markets, obviously, but another difference that we observed is definitely coming from the nature of the products. So depending on how young is the demographics of your product, and how easy is the technology and regulatory implications to turn it into the ecosystem, we will see probably waves of this transformation happening, with everyday banking probably much earlier than, for example, mortgage and investments. So all in all, I would like to close with this my presentation. So just to summarize, valuation of banking are still challenged, despite all the changes that happened in the past 1.5 years. Those of us who are outperformers in this aspect are doing 4 things. They are in the right geography, they have scale, they are focusing on the segments and serving those segments with specific needs, and they have specialized, focused business models, often advancing into ecosystem or platformized direction. And I would like to summarize with this one slide. This is just a hint of like all the different strategic steps that can be done, but really my last message would be is that there are all the short-term challenges hitting banks that you need to handle, but at the same time you also have to look at the longer horizon and especially on how the business models are shifting, because many of the players are coming at this direction. Thank you.